Demographics are the silent force that shapes the modern market. The shift isn't subtle. Japan's population has declined for over a decade. China's working-age population peaked in 2015 and, according to recent data, fell by about 5 million through 2022. Germany is projected to lose 5 million workers by 2040. These aren't just numbers. They're structural changes that drive how capital is allocated and how markets behave. Pension systems make the pressure visible. In the U.S., the Social Security Administration projects its trust fund reserves will be depleted by 2034. Japan's pension system now holds nearly half of all domestic stocks, a direct response to the need for higher returns in a world with fewer workers supporting more retirees. As populations age, pension funds must chase yield, pushing them into riskier assets and amplifying asset price inflation. Central banks tolerate this dynamic because the alternative, a collapse in asset prices, would trigger pension crises and broader economic instability. The link between demographics and market outcomes operates through several channels. Older populations tend to save more and spend less, which creates persistent deflationary pressure. Japan's experience is instructive. Decades of stagnant prices despite ongoing monetary stimulus. The Federal Reserve's own research attributes about a third of the decline in neutral interest rates since 1980 to aging demographics. This trend isn't reversing. The U.S. median age will rise from 38 to 43 by 2050. Over the past 2 decades, demographic drag has more than halved U.S. working-age population growth. Housing markets also reflect these shifts. In Canada, for example, population growth stands at just over 1% a year. Yet home prices have climbed 50% in 5 years. This disconnect is explained by the timing of generational demand. Millennials entering peak home buying years while baby boomers hold on to properties longer. The result is a housing squeeze that policy alone can't resolve. Similar patterns show up in healthcare stocks, which have outperformed the broader market since 2010. Not primarily due to innovation, but because demand rises as populations age. China's demographic reversal is a warning sign for other economies. Its working-age population has already peaked, and projections show a steep decline by 2040. This shift explains China's efforts to steer capital from real estate toward productivity, enhancing sectors as the demographic dividend that once fueled rapid growth turns into a headwind. Joseph Davis of Vanguard points out that demographics, along with technology and fiscal debt, are core megatrends shaping economic growth and inflation. The impact is clear. Older populations invest rather than spend, so rate cuts inflate asset prices instead of boosting consumption.